Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, September the 15th. I'm going to take just a brief minute to discuss what markets did last week as we ended the losing streak of August as we started off September with a nice up week in the markets. But all eyes this week were on Tuesday's CPI report, so we're going to discuss that and the impact that it has on markets and where we see markets moving forward. So last week the markets were up. The S&P 500 was up 3.65%. The mid cap index was up 4.69%, and the small cap index as measured by the S&P 600 was up 2.3%. So the mid cap index continues to outperform year to date the large cap index of the 500, the S&P 500. But as we entered into this week, all eyes were on the CPI report that was coming out this week on Tuesday, and what everyone was anticipating was that the numbers were going to be less than expectations. Well, unfortunately, the numbers came in higher than expectations. Now, while they're still lighter than they were in July, the decrease month over month is not as significant as investors were hoping for. So you saw a significant drawdown in the marketplace on Tuesday. 1,200 points on the Dow, 5% on the NASDAQ, down for the day. And why was that? Well, that meant that investors said because the inflation isn't coming down as quickly as we were hoping, that the Fed is going to continue to have to be more aggressive in raising interest rates as they fight inflation. And that has a very big impact on the growth stocks. That's why you saw the NASDAQ down worse than the Dow. But let's put things into perspective real quick. I know that's sticker shock. It's a big deal when the Dow is down 1,200 points or over 3% in a day. But essentially what we did was we just reset last week's exuberance. We were up significantly last week, and we just pulled back to the levels that we were heading into the beginning of last week. We just took those back on Tuesday. Now, one of the things that we wanted to talk about is we really believe that we've entered into a broad-based trading range where we're going to see a bottom around 3,700 and a top around 4,100. And we're going to navigate through here as interest rates fall. You'll see the NASDAQ go up. Today, what you're seeing is interest rates continuing to rise, and you're seeing the NASDAQ underperform and be down. And that correlation is going to exist in the marketplace until we get some clarity on an end for the Fed raising rates, or we see inflation is significantly coming down and coming down quickly. The problem the Fed has is they're using data that's already old and antiquated data. We are talking about August's CPI report, and it is September the 15th. And things are very fluid. And one of the things that we have to be cognizant of and mindful of is as the Fed is navigating and doing this, monetary policy takes between 6 and 18 months to really gain traction, or for us to really absorb what the policy has done. And so we really haven't felt the effects yet of the big 75 basis point rate hikes that the Fed has put in here recently in the economy yet. We're still just at the very beginning stages of digesting that. And if you look throughout the industries, we're starting to see inflation come down in areas that have been really keeping inflation up. 30% of the CPI index is comprised of housing expenses. Well, housing is quickly coming down, as well as rent expenses are quickly coming down this month. Those are great things. The other thing is not all inflation is bad inflation. We have been in a deflationary environment for at least the last 20 years, thanks in part to globalization and technology. One of the things that has suffered over the last 20, 30 years is wages. Wages haven't moved upwards in 20 to 30 plus years. We just haven't seen wage inflation. We're starting to see some of that right now, and we are seeing that right now. That's not necessarily a bad thing. And it's okay if we let the inflation for a short term run a little bit higher than the 2% mandate that the Fed has. Because remember, the Fed has a dual mandate. It is to keep inflation around the target of 2% and to maximize employment. Well, what the Fed is doing is talking very, very aggressively and very tough, But they have to be cognizant and mindful of that dual mandate. If they've raised rates too much, they can have a severe impact on employment and can really cause employment and wage inflation to really start to decrease, which would have a negative impact on the economy as a whole. So the Fed is walking that tightrope of trying to slow us down enough to decrease inflation pressures enough, but what we don't want to see happen is the Fed raise too much too quickly and then have to reverse course on a very quick stance. So what this means is we've entered into this trading range that I discussed between 36 and 3,700 on the bottom and 4,100 on the top. So if you have questions about how to navigate through this trading range or what we're seeing or how to take advantage of these opportunities that you are presented on these big down days that you saw on Tuesday, call us. We're happy to help you navigate through this and take advantage of this and maximize your opportunities as we look through the future in the next 6, 9, 12 months. So thank you as always and have a wonderful rest of your week. You can call us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. Have a wonderful rest of your week, everyone. Thank you so much.